Both JEPI and JEPQ are insanely popular among investors. But why? And is one better than the other? And are there any hidden risks in investing with JEPI and JEPQ? These are the questions that we'll tackle in this video. Both JEPI and JEPQ are so-called derivative income funds, meaning they not only invest in stocks, but they also sell covered call options to earn their higher yield. Without getting too technical, here's what to know. Selling call options allows JEPI and JEPQ to generate recurring income each month. This income is in the form of call options premiums that these funds sell or go short on. And this is in addition to capital gains from their stock portfolio. JEPI has a yield of 7.2%, while JEPQ has a yield of roughly 9.2%. The yield, of course, fluctuates. And this income from covered call options can protect investors. It provides valuable protection from downside, but up to a limit. If the stock market decline is large enough, both JEPI and JEPQ will decline too. The drawback of covered call funds is clear though. When the stock prices of underlying assets start to go up, these covered call positions start to bleed money. That's why you see JEPI and JEPQ trail their benchmarks by a wide margin in bull markets. Now let's compare these two funds further. Both funds are by JPMorgan and are actively managed. This means that there is some discretion when it comes to selecting stocks. JEPI's goal is to construct a defensive portfolio to achieve returns similar to S&P 500 but at a lower volatility. The fund uses JPMorgan's proprietary data to buy stocks that will decline less in bear markets. Conversely, JEPQ loosely tracks the performance of the Nasdaq 100 index. JEPQ can at times hold stocks outside of Nasdaq 100, but their weighting limit is 20% of its assets. You probably know that Nasdaq 100 has been outperforming S&P 500 for the past decade or so. Add to this the AI rally of the past year, and it's not surprising that JEPQ outperformed JEPI. But we will come back to returns comparisons shortly. Besides holding stocks, both JEPI and JEPQ sell call options. But they don't do this directly. Instead, they do that through equity-linked notes or ELNs. ELN is a structured investment product that sells call options and distributes any income to its holders. So JEPI uses ELNs to sell one-month call options on S&P 500, while JEPQ does the same but for Nasdaq 100. Both funds, they can invest up to 20% of their assets into call option strategies. But mind you that the investing in call options or options generally is like using leverage. So even 20% can be big enough to overpower the gains from the rest of the portfolio. Also, there are a few unique inherent risks in ELNs. First, they are subject to counterparty risk. Both JEPI and JEPQ, they buy these products from other large financial institutions. And at times of stress, these financial institutions may fail and will not hold their part of the bargain. And this could be devastating for these funds. The good news is that these funds, they are only allowed to transact with large, systematically important financial institutions via competitive auctions. So this mitigates this risk. The other issue with ELNs has to do with how their income is taxed. As you may know, there are many other covered call funds with large yields. Many of them do short call options directly instead of buying ELNs. Typically, income from selling call options is classified as capital gain and doesn't go into yield calculations for the fund. For instance, here's a fund called Global X S&P 500 Covered Call ETF or XYLD. Its SEC yield stands at 0.8% because this type of yield counts only dividend and interest income. Of course, XYLD has massive distributions that count as capital gain and produce large yields. With ELNs, it's different. Income you receive from JEPI and JEPQ is interest income and taxed at regular income tax rates. That's why when you look at the SEC and 12-month yield for JEPI and JEPQ, you see close enough numbers. Nevertheless, if you're planning on holding JEPI or JEPQ in a taxable account, this could be a very bad idea. It is especially true if you're a high income tax bracket individual. Conversely, if you fall under the low tax bracket, the issue is less severe, but it's still there. Now, let's quickly understand why JEPI's yield is lower than that of JEPQ. At the end of the day, it all comes down to volatility of indices that these funds short with covered call positions. Paradoxically, call option values tend to grow when volatility goes up. The intuitive explanation is that with high volatility, there is a higher chance that the stock prices will land in the territory that is beneficial for call option holders. Historically speaking, Nasdaq 100 has been much more volatile compared to S&P 500. This alone produces higher covered call income for JEPQ compared to JEPI. Hence, JEPQ has a somewhat higher yield too. But if volatility subsides for either or both of these funds, the yields will come down too. And counterintuitively, investors in both JEPQ and JEPI should embrace and love and appreciate volatility because it produces high yields for them. Another factor behind high yields for these funds, especially recently, has to do with high interest rates. Keeping other things constant, call option value tends to grow as interest rate goes up. But it could be that the recent high interest rate episode is coming to an end, which will not be beneficial for JEPI and JEPQ high yields. When comparing expense ratios for these funds, they're the same at 0.35%. While they're somewhat higher compared to, let's say, S&P 500 plain vanilla ETF, you get a lot of income in return. And also these funds, they engage in somewhat complex strategies, which could be justifying for their higher fees. When it comes to portfolio composition, here's what we see. These funds have an overlap of about 26%, which is low. Unsurprisingly, JEPQ is heavily tilted towards the tech sector. Conversely, JEPI has much more even allocations to various sectors. In fact, JEPI has a mandate where no single sector can account for more than 17.5%. JEPQ has none of that. So if sector diversification is important to you, JEPI could be a better option. As for the individual stock positions, the Magnificent 7 dominate JEPQ portfolio. The fund is top-heavy at almost 43%, with some stocks scoring 7% allocation. As we will see shortly, such high concentration caused JEPQ to outperform JEPI recently. As for the JEPI, the fund is required to invest less than 0.5% of its assets in a single stock. Finally, here's a comparison of total returns. Unfortunately, there's barely anything to compare since JEPQ came to life in 2022, while JEPI in 2020. We see that JEPQ had massive outperformance. That is unsurprising with the AI rally. But in the recent month, things turned sour and AI rally stalled, or it seems so. This is where JEPI shined. Another observation from here is that covered call funds tend to underperform benchmarks in bull markets. We clearly see that from outsized returns of S&P 500 and Nasdaq 100 compared to JEPI and JEPQ. So yes, high yields may be enticing. Still, it's always a good idea to check and compare total returns. Here, we reach this part where I should conclude and tell you which fund is best. But the thing is, there are no definite answers here, as it all depends on individual preferences. So instead, let's see under what scenarios one fund could be better than the other. JEPI is more suitable for someone who desires high yield but wants to hold a stable portfolio of defensive stocks. Conversely, JEPQ has higher yield but at a cost of higher drawdowns and volatility down the road, if that's a concern for you. As for the price appreciation, it all comes down to your views, whether you think Nasdaq 100 or S&P 500 will outperform in the future. Historically speaking, Nasdaq 100 outperformed S&P 500, and that's why JEPQ shined in the last 2 years, especially as the big tech and AI rally intensified. But there is nothing says that this can hold in the future, and maybe S&P 500 will outperform, or they will be on par. So depending on your views on these two stock indices, you may find one fund better than the other. Both JEPI and JEPQ are most suitable for tax-deferred accounts, as I mentioned before. Otherwise, you'll be paying unnecessary taxes each year that you can easily avoid. Finally, covered call funds shine in sideways volatile markets as they capitalize on their covered calls strategies. With bear markets, they may provide some downside protection with these covered calls, but not a whole lot. Also, bull markets are the real killers for relative performance of these funds, and holding S&P 500 or Nasdaq 100 could be a better option in uptrending markets. And this is especially true if you're someone who has income and doesn't need to retire in the next 10 or so years, and you can wait. But for retirees, both JEPI and JEPQ represent a real advantage with their high yield. And that is it for this video, guys. I hope you learned something new and you found it useful. If you did, please give it a like and subscribe to my channel for more content on investing. Thank you for watching.